Good morning from Hong Kong. It's 9 a.m. here in the city, in Beijing and in Shanghai. Welcome to Bloomberg Markets. China Open. I'm David Ingles with Yvonne Man.
Our top stories this morning, a cautious mood in markets after U.S. equities fell. The yen strengthening on that stronger than expected Japanese inflation data. Bitcoin touching its highest price in more than 2 years. U.S. shares of Li Auto jumped after the automaker reports a solid fourth quarter performance. That's despite that price war in China's EV market. And fast fashion retailer Shein said to be considering listing in London as its U.S. IPO plan faces resistance.
Yep, there we go. Lots of stories to get you through the next 60 minutes or so. Thanks for joining us today and hope you're all well. Mark, as far as markets go, I think depending on which benchmark you look at in the U.S., so most of the major benchmarks were down, although some of the ones that had the sort of chip representation, stocks, obviously, for obvious reasons there, closing higher as well. So there's divergence in the U.S., particularly between, not just in tech, right? Within tech, AI and everything else, that theme continued to move apart. 1/10 of 1% to the downside right now. NASDAQ futures, as you can see on your screens. Nikkei, though, is, again, going the complete opposite way as most, and hasn't really been the case. We'll talk about the inflation print out of Japan in a moment. Speaking of data coming out, Taiwan export orders are coming out later today. We're coming off quite a steep drop. While we look at these markets in Singapore and also in Korea, a steep drop in both yesterday. Flip the boards, please. Currency markets doing this. We talked about dollar yen. That dip, of course, we're a little bit higher from post, at least the trough a few minutes ago following the release of the inflation numbers coming through. A drop from the previous month, but above forecast on most metrics. Bond markets, a lot of auctions today in the region. We're looking at CGBs, 10 and 30-year. 30-year in particular, 6-day rally there. We're now trading at, 2.5% on 30-year tenor and CGBs here. Very, very quickly, commodity markets, and perhaps the other big story in markets today, Bitcoin 54. That takes us back 2.5 years back. That's about now 24% up year to date, 24% too, going back to all-time highs. If we get that, we're back to ATH, as they say. And of course, sorry, I forgot to mention here, iron ore, there we go. Miners under pressure on the back of this. I think we're down 20% almost now from the peak on iron ore prices.
So nearing that bear market when it comes to iron ore, is that some sort of signal for China in some ways as well? You take a look at what's on the agenda here today. There is that NPC Standing Committee meeting that is taking place here. We might get some announcements on different posts, right, including maybe a new foreign minister that we're looking out for here today. Auto chip stocks very much in focus, as David mentioned, with those Li Auto ADRs surged about 18% overnight. That crypto rally, we'll see how those crypto stocks here in Hong Kong do. There is also reports and also this meeting that we're hearing about from the top Beijing official to Hong Kong, Xia Baolong, here in the city. Trade data coming out from Hong Kong as well, of course, and as Dave mentioned, that CGB rally, whether we see a 7-day of gains here when it comes to fixed income.
Yep, absolutely. Long-dated bonds in focus. And, we talked about, as Ivana's pointing out, Li Auto, right? One of the stocks we'll be tracking closely today. That's an earnings story, and perhaps earnings is one to watch as you look ahead. We're 5 weeks into this equity market rally here in the region. Goldman Sachs, their latest report, rebound underway. The continuation depends on earnings and policy delivery. One of the authors of this report, Sunil Kaul, is with us right now, APAC equity strategist at Goldman Sachs. Sunil, good morning, sir, and hope you're well. Thanks for joining us. 5 weeks into this rally, how are you looking at things?
If you look at the rally, as you just mentioned, we have been seeing most of the markets in the region are actually rallying from their sort of declines in the early January, right? If you look at the index level, it's actually flat year to date. But I think the key point is beneath the index, there has been a lot of sort of disparity across markets, across sectors, across styles, right? I mean, the best performing market versus the worst performing market, Japan and Thailand, we have a 14 percentage point spread there between the best and the worst sectors, energy and material. There's a 20 percentage point spread. And value has actually outperformed growth by 16 percentage points in just sort of 8 weeks. I think that shows you that how much sort of alpha opportunities are there in the region. So our sense is that valuations in aggregate are sort of fair, And so from here on, it will be the underlying profit delivery which will drive markets higher. So we are penciling in around 15% earnings growth this year for the region as a whole and 11% next year. But that's somewhat upwardly distorted by Korea and Taiwan rebound in the tech earnings there. So if you take them out, that's roughly around 8-9% sort of stable earnings for the next couple of years, which is what our index target roughly is. So markets basically grind higher with the underlying earnings.
Everyone's been focused on what the Mag 7 big tech in the U.S. has done in terms of bringing the S&P to all-time highs. What are you looking at in terms of leadership here in the Asia region here? Are the large caps what's driving some of these gains, and where is it most pronounced?
Yeah, I think we actually looked at that in the note as well. So there is that sort of large cap outperformance in the region as well. It's not as pronounced as sort of the Mag 7, as you mentioned, in US, and there are some similar sort of group of stocks we call granolas in Europe. But in Asia, most of the sort of cyclical markets, Japan, Korea, Taiwan, they have seen large cap kind of doing better. I think the one market where actually mid and small caps have been doing better, which is on the other extremes, India, as I have been pointing out, there the mid and small caps actually rallied significantly compared to the large caps. But apart from that market, I think the other more globally cyclical markets, we are seeing this phenomena, although not to the same extent as Mag 7 in the US. So it seems that the rally is a little bit more broad-based here as opposed to in US.
Yeah, which, to your point, has been extremely narrow. I just want to touch on something you also mentioned here, some of the winners, right? So you mentioned value over growth in Asia. Cash has been king, so high dividend yield stocks have been outperforming. On those two things, does that continue?
We do hope so, and then that's our view. I mean, for the value outperformance, as I'm sure you know, there is also the catalyst both in Japan and Korea with the corporate governance reform and the value program, details of which for Korea just got announced yesterday, which were in line with our expectations. So we think that sort of corporate reform change, both from Tokyo Stock Exchange and Korea, would continue to drive rally in some of these value parts of the market. On the cash, on your question about cash, David, I would say we think sort of safe and secure dividend yield continues to perform well as we have been seeing in the market. So we continue to like both of those themes.
We're about 60% through in the reporting season, Sunil. What's your kind of assessment so far? What's really stood out to you?
We are 60% through in terms of the reporting season. There, obviously, India, Japan, they have finished their reporting season, so the numbers are out. I think the numbers are actually coming in better than expectations. In India's case, profits were up 17% year on year, and the calendar 2023 profits, that brings it to 20%, which is an important point because that basically shows that the 20% rally in the market there was just driven by underlying earnings, which is why we still like that market. Japan numbers are also coming in better than expectation. I think we will have bulk of the China numbers come through in the next few weeks. There we think the numbers may be a tad softer compared to the expectations from the market, because if you look at the profit alerts, I think there have been sort of 60% of them have been on the negative side, which means that I think there may be a bit of downside surprise on those numbers. But so far, in aggregate, numbers are coming in a tad better than expectation, which is and coming in pronounced in some of the cases. I think Korea is another case in point where we haven't seen the full numbers come through, but the earnings are up 100% year on year, which is after 5 quarters of decline, which is in sort of consistent with our view that in Korea we are in the early stages of cyclical recovery, which is already happening in the earnings, which is why we are also sort of overweight that market.
Understood. Now you mentioned China and earnings. What's more important in China, earnings or policy at this point?
We literally have the view that for markets, obviously there is a rebound rally there, right, which could continue because both valuations and positioning are at lower end of their historical ranges. But for market to do well, I think we need both of those things. So we do think that you need more forceful policy easing in China, and we probably will get some more details in the two sessions later next week. And then at the same time, I think it has been that the earnings have been disappointing for a while now. We do think for the full year next year, we could see a sort of 10% earnings growth compound over the next 2 years in China. The consensus, as I said, is a little bit more higher, with sort of 14% and 17%. So even though there would be some downside surprise to those, we think if market can deliver 10% earnings growth plus more forceful easing, you could see a decent run-up in Chinese equities.
And what would be leading that rally right now in China? I mean, if there's something that, given just how cheap valuations are there really a lot more opportunities out there now in these mainland markets?
Yeah, I mean, in the market, we have been sort of emphasizing this theme of China rebalancing. So that would include, so within, at the broad level, I would say we like the China domestic market more than the offshore markets, because in domestic market, obviously, there is some policy support, but also national team, evidence of national team buying. So that's sort of A over H. And within that, as I said, I think the China rebalancing theme, which sort of speaks to both sort of hard tech, as well as sort of the technology self-sufficiency theme. I think those themes can do well. I think depending on what comes out of the two sessions, you could also see parts of SOEs do well in terms of SOE reform theme. We also are, similar to the region, we are also emphasizing the dividend theme in China as well. So plenty of ideas to choose from.
Sunil, just quickly on that note, is momentum in place for the national team to step away from this market, or is that support still needed over the short term?
Yeah, we looked at some of the numbers, and our sense was that I mean, it's as of last week, but you had roughly sort of 20 billion odd, 30 billion odd in US dollars, which is the extent of flow that had come in. As of last Friday, I think the number sort of is increased to almost 40 to 50 billion. Our sense is that you needed at least sort of north of 100 billion for markets to stabilize. So I would say in the near term, you probably will continue to need that sort of policy support or national stabilization fund. What's noteworthy, though, is that if you look at the flows so far, we haven't seen broad-based pickup in flows across China-focused mandates. The flows have been very focused in the top 5 ETFs, CSI 300 ETFs, which are largely held by the national team. So in addition to, I think, national team support, it'll be good to see that flow broad-basing and seeing more investors kind of putting money into Chinese equities. But we are yet to see evidence of that in the data.
Sunil, great stuff. Sunil Kaur there, APAC equity strategist at Goldman Sachs, joining us. Still ahead, we're talking to Mizuho Securities, explaining how China's cuts to front-end lending rates will eventually catch up later on this year. Senior China economist Serena Zhou joins us a little bit later on.
But ahead of that, fast fashion company Shein is said to be considering listing in London. That's ahead of the U.S. Our coverage on that story coming up, counting down to the open of trade, 16 odd minutes away. That's Hong Kong for you this morning, Tuesday morning. Hope you're all well. This is Bloomberg Markets, China Open. Good morning. Okay, welcome back to shows. You're just in time for the midpoint of the day, and similar to many items in my fridge, it's been unchanged and in place for about 2 months now. There we go, 710 and change on the renminbi midpoint of the day. There we go.
Yep. Really not much of a story there because it's been solid. We were just talking about how many days we've seen that fix at 710.
Yeah.
Let's talk a little bit more about one company, though. Shein, the fast fashion company, said to be considering listing in London instead of the U.S. Sources are saying the firm thinks it's unlikely that U.S. regulators would approve an offering there. Let's get more now from our Asia IPO reporter, Pei Li. What more do we know about this now?
It's really interesting that Shein now is seriously considering London. It entertained the idea of London before, when there was all this noise of, oh, what are they going to do with the U.S. and then what are they going to do with the Chinese regulations, right? So now they're seriously thinking about it, knowing that the U.S. might not grant them green light. We have to also remember that the the company is fighting two battles. Not only they have to get approval from either London or New York, they also have to get approval from China, which is a process that normally would take at least 6 months. When they filed confidentially last year for New York, they did submit an application. If they're going to proceed with London, they have to do it again. So, it's kind of interesting for us to, really follow all this back and forth. Obviously, politically, it's, the main reason for them to choose to think about London over the U.S. And, if this one doesn't work out either, I think, they might think about Singapore next, as we reported in the story.
Right. And so is this final? Are they still working on the process for the U.S., for example?
They're still in the process of going through the U.S., right? But it's just that in this communication, I think they got the understanding that it might not really come to anything, right? And then what are going to do next? So I think London now is definitely one thing that preparing for, and so to be sure, they haven't really formally filed for London, right? But if this thing doesn't work out, in New York, then they're going to proceed with that one.
There we go. Other potential venues, as you guys point out, of course, Hong Kong and Singapore in the U.S., but of course it does seem London is in the driver's seat. And this one, Pei Li, their IPO reporter, fantastic reporting from them and the team there. You're right, Li Auto shares overnight plus 18%, and in a couple of minutes you'll probably see something similar in the pre-markets here in Hong Kong. We're called to fly. We're called to stock is called what, $160. That's Hong Kong dollars here. That's down to earnings. Let's bring in Linda Liu, who has a story for us. And I think the question here, how did they buck the trend of these price wars, racing ahead of peers, Xpeng, Neo, to achieve really a full-year profit for the very first time here, Linda?
Like you said, it's a really stunning performance given what a tough year it's been for all of these EV makers in the China market. There's a price war, EV growth is slowing, so there's a lot of challenges facing Li Auto. But what they did manage to get right was really focusing on their product offering. They make these very roomy, luxurious SUVs that targeted towards China's middle class, and customers have really taken on their EVs. These are extended range EVs, which really solves range anxiety for the customers. So you're really seeing that kind of preference from customers translate into their sales. And more than doubled last year, and they smashed their sales goal of 300,000 deliveries, rising to 376,000 by the end of the year.
So can they sustain this sort of winning streak, Linda? I mean, what's in the future for the company, and how will they continue to navigate this fierce competition right now?
It's a good question that everyone is pondering, given how tough the Chinese EV market is right now. So Li Auto will be launching their first pure electric offering in the coming months. It's a 7-seater minivan called the Mega, and that's also a rising class of EV that's becoming popular in China. Li Auto CEO also said that they're going to be launching 11 new models within these couple of years. So they're really hoping to widen their product offering to attract more customers. And time will tell if they're really going to follow through on their ambitions. The sales goal have also more than doubled for this year to 800,000 units.
All right. Linda, thank you, Linda Liu there with a breakdown of those earnings. And as you're seeing in that pre-market now here in Hong Kong, Li Auto shares popping some 15%. So really mirroring what we saw in the U.S. overnight. Some other corporate stories that we're tracking for you this morning. Chinese car maker BYD says it's been contacted by the Italian government to bring some of its auto production to the country. BYD's Europe managing director says the need for a second European plant depends on sales volume. Italy is looking to attract another auto manufacturer after Stellantis signaled it may move production to lower-cost countries. U.S. regulators have faulted Boeing for ineffective procedures and a breakdown in communications between senior management and other staff members. An FAA panel also found what it calls a lack of awareness of Boeing's safety-related metrics among employees. The report comes after a mid-air fuselage blowout in January refocused the spotlight on Boeing's safety issues. We're watching Woodside Energy shares. They're up in Sydney after the oil and gas producer reported full-year underlying profit that beat the average estimate. That's despite the number falling 37% from a year earlier on lower energy prices and a $1.5 billion write-downs on assets. Woodside says it will continue to spend modestly on exploration. Plus, we'll be speaking to the Woodside Energy CEO and Managing Director Meg O'Neill about the earnings and outlook. That's going to be 2 p.m. Sydney time, 11 a.m. here in Hong Kong.
Right, just under 8 minutes to the opening bell. We're called slightly higher on the Hang Seng China Index. We're looking at one stock in particular that's going to come up bottom of your screens in 5, 4, 3, 2, 1. Li Auto up 15% in your pre-market. Plenty more ahead. This is Bloomberg. All right, welcome back to shows here. So I'll be generous. We'll probably see some upside and tailwinds coming through in offshore markets, although the sort of profit taking is still taking place. We had a down day yesterday in Shanghai and the CSI 300 after we touched 3,000. It's looking like we will see some pressure still onshore. The yuan fix has been steady for about 3 months or so. More on that in a bit. Of course, Mizuho joins us. Serena Zhou talks us through all things economic when it comes to China.
Yep, and then we're taking a look at when it comes to analyst actions here today. So some earnings-based ones. Bank of China A shares rated a new strong buy at China Merchants with a price target of 510. Kuaishou Tech cut to a hold at Hedgeye. Li Auto, that's the one stock we're watching here this morning, raised by Citi with a price target of $220.30. They also raised their sales estimates for Li Auto for 2024 through to 2026 on that vehicle margin beat there here as well. So that is the stock of the hour, really. Take a look at how EV stocks are doing. Li Auto with that 15% pop in the pre-market. This is how the rest of the EV sector is doing here. You see BYD up some 2%, XPeng up 4% on those better than expected numbers out of Li Auto. And crypto, right? When we're talking about more than 2-year highs for Bitcoin in particular, we're watching these crypto stocks. There you go. Huobi Tech up some 9%. OSL Group up more than 14% right now. CLP Holdings, that's the one that came out as well from, with the earnings and everything. Not much movement there. Citi, though, did upgrade the stock to buy from neutral, saying uncertainty from its Hong Kong business has been removed.
A couple of other items we're tracking today. Export numbers are coming out of Hong Kong. The CGB rally that's now extended 7 days under 30-year. And also the NPC Standing Committee meeting wraps up today. Look out for announcements from that specific huddle in Beijing. The opening bell 3 minutes away. This is Bloomberg. Good Tuesday morning. Welcome to... It is Tuesday. Yes, it is. Okay, 40 seconds to the opening bell. Feels like we've been here for 3 days now this week, right? We had a long day yesterday, wasn't it?
It's been a while we've been together, Dave. That's why.
There we go.
You miss me too much.
And you guys are in for something special next week. Stay tuned for that. Welcome to Bloomberg Markets. China Open. What are we talking about today? Li Auto's a stock to watch. The NPC Standing Committee is meeting today. I think CGB rally's in focus as well.
Yeah,
what else
6 days on the long end, really, on this rally. So really not taking part. You're not seeing that sort of, I guess, pullback across fixed income in China, despite this equity rally we've seen for some weeks now. So what does that tell you about the long-term prospects of the economy? Are people still a little bit bearish, at least, when it comes to the long-term growth of China? But take a look at when it comes to what we're seeing across these markets. So yesterday we did snap out of that rally a little bit, and we're seeing a bit of a breather here across stocks. CSI 300, we failed to kind of keep that psychological line of 3,500, 3,000 for the Shanghai Composite. We're watching those levels very closely. closely here. 0.5% down for onshore. HS Tech, though, is catching a bid. Obviously, Li Auto is driving a lot of that, given the earnings, the stellar earnings that we saw from that EV maker. CGB's not doing a whole lot, but that 30-year continues to head lower where yields are. We're down some 2 basis points at 251. I believe those are still record lows for that one. Shanghai crude is up. The iron ore, as we've been talking about, we're very close to a bear market in iron ore futures as well, whether you look at how Singapore and Dalian play out. And it looks like it's mostly red across these sectors here, with the exception of consumer discretionaries. Developers are flat. It's a pretty kind of broad base, I would say, weakness for the most part. Onshore rate is below that 720 level. At least we're seeing some strength for that currency. But certainly we're watching very closely. The national team, UBS, was crunching the numbers. They're talking about, $57 billion that were piled into stocks. It's certainly one to watch, right? Because are we likely to see more support measures coming through? Or are we sort of in that blackout period, which some analysts have told us up until MPC? That still remains a big question, whether this market needs that support.
Right, which is a few days away. Interesting insight coming out of Goldman Sachs joined us a few minutes ago that, whether it's earnings or policy, this market needs both, and maybe slightly more as it pertains to the national team coming in as well. In fact, on that note, this question is posed by our guys at Bloomberg Economics. The CSI 300, dead cat bounce, or is it a dragon run? As they're pointing out. More on that in a moment, of course. Lots of other stocks that we're tracking here still across these markets.
There's the auto space, right? So Li Auto, obviously, somehow they were able to defy this price war and come out with full-year profit for the first time, right? 17% pop there. Basically, we're seeing similar to what we saw in the ADRs overnight. You have Cities, you have Jefferies raising their price targets for that stock in particular, and that's really helping to lift the auto sector in general. CLP Holdings also on the back of those earnings up some 3%. SF Holdings, we're watching some of these logistics stocks. So there was this vow from China to dismantle local barriers to build a national market. So one closely watched sector there as well. Not a whole lot of movement with SF Holdings, but Bitcoin, that continues to be the one story that we're tracking as well. Look at OSL Group. It's up some 13% right now. 54,762 is the price of Bitcoin. And if you take a look at what we're talking about in terms of records, right? I mean, we're about 10% away from 60,000 or so. Yeah. We're watching very closely whether we reach that ATH, as we say, of 68,991 that was set in November 2021. But the stocks are liking it, Dave.
Yeah. Whoever had two things in their portfolio, 50-50, Bitcoin and Li Auto, congratulations on you. To nobody who had that. Yeah.
You got to wonder what's driving, but it really kind of reflects on all this money that's going into these ETFs right now.
Yeah, there's a ton of it, too. And, when you draw, in fact, Yvonne's point, right, 10% to 60,000. If we simply repeat the leg year to date to the current level of 24%, we're back to 80 all-time highs on that. Right. Now, we teased you a little bit with our analysis, not our analysis, Bloomberg Economics analysis. We're just taking advantage here. The CSI 300, dead cat bounce, or is this a dragon run? Watch the NPC according to the model composition or the asset price decomposition model from our folks at Bloomberg Economics. And what effectively they're saying is three things have driven this market up: monetary policy, hopes that things will better, and expectations of more policy support coming out of the NPC, to underscore really how important next week is going to be here for these markets.
And a stronger global risk on move. They've also been crunching the numbers and at least gathering the numbers from provincial governments, right? And the growth targets that have been set there. And what they're suggesting that it seems like we might actually still see a national growth target at this NBC be announced to stay at 5%, which is quite interesting, too.
That's based on the, asking each unit what they will probably deliver. Well, let's put that question to Serena Zhou, here with us on set, Senior China Economist at Mizuho Securities Asia. Good morning and nice to see you.
Nice to see you.
So work reports this next week, the NPC. Our folks at Bloomberg Economics, they've looked at local government and they think 5%. Does that make sense? Is 5% your target or your projection on the target?
Yeah, I think the government is also going to target around 5% GDP growth target and change from last year. But I think this should be a good news for the market, as I think most people are expecting a growth rate for this year in between 4.5% to 5%.
How hard will it be to reach that 5%? What will we need to see in terms of policy?
Yes, I think the government still need to do some additional efforts to help the growth rate. I expect there will be more cuts to front rate later this year when we have a clear picture of federal rate cuts. And also, I look for more policy support towards the property sector. And I believe the central government will taking a big role in boosting domestic investment.
Okay. You mentioned something interesting. So you think the PBOC needs to wait for the Fed to cut rates before they move on the front end. Why is that?
Yeah, I think the reason a symmetric rate cut shows the PBOC's efforts to support property demand while minimize additional volatility in the FX market. So in that sense, probably we won't see any front-end rate cuts in the near term as the market expectation for rate cuts still evolving.
Okay. The fiscal deficit, have we talked about that? I mean, what are you expecting that number to be?
Yeah, I think this year's target will be slightly higher at 3.5% compared to 3% last year. And the actual fiscal deficit will be even higher if we're considering the funds raised last year that has not been used yet.
Would you consider that, all that together, would you consider that fiscal supportive? Is that something more than what the markets are expecting, or is that almost set to neutral?
I would say neutral, because you look at those work reports by local governments.
Right.
Basically, most of them set a lower FAI growth target for this year, meaning probably there won't be that much efforts into boosting infrastructure investment this year.
The property sector, as you mentioned, you're still looking for more signs of support there. The data hasn't quite turned around. How much do you think, the weakness that we're seeing in home prices, for example, how much of a drag is that on the consumption, overall consumption, and balance sheets and the like here? Do you think those fears of a whole negative wealth effect, are those warranted or overdone?
I think there has been a growing consensus among Chinese policymakers that now the property sector in China is reaching to a new equilibrium that aligns with China's new norms. So in that sense, the government will be intensify their efforts in preventing the market from overly correction. But that said, we still believe that for the government to extend direct support to private property developers through policy banks and AMCs will be quite important, but we don't see that happening anytime soon.
Serena, thank you. Nice to talk to you. Let's talk again. That's after they announce all these things, and we can unpack that. Serena Zhou, there's senior China economist at Mizuho Securities Asia. Right, a brief check of markets. We're about 8 minutes into the session. Benchmarks looking like this. We're split between almost quite literally onshore and offshore. Up 1% on the HS Tech Index. That's a standout so far. This is Bloomberg. Right, welcome back to shows. 10 minutes into the session. Nothing to see here, as you can see on your screens. Let's move on, please, if we can. There's a great story out. Today we're talking about bankers. We're talking about labor market flows. We're talking about government policy. And certainly the call from the Chinese president for common prosperity has hit the banking sector, particularly salaries of the bankers, quite hard here, and triggered an industry brain drain. Joining us now from Beijing is Lucille Liu to talk us through the story. Lucille, quite a lot to unpack when it comes to this story. We mentioned brain drain. Give us numbers. How much are we talking here? How many people?
Yeah, I mean, it's hard to have the full calculation there, but we know that, some of these salaries have been slashed by half. So, people are looking elsewhere when that starts to happen to your salary. And of course, that's not the only thing. There's this ongoing corruption probe that's taken down already, 100 finance officials and executives just last year. So I think that's really sending a chilling effect through the industry. On top of that, they've been told they're hedonistic and, need to follow the centralized leadership of the party. A lot of people are interpreting that as basically, spitting out the money they've earned. There was this anecdote, someone was saying, before we were moving these fatty pieces of meat around, what's left on your hand is yours. That's the incentive of the industry. Now you're asked to wash your hands. So the prospects of this being a very lucrative industry are gone. And so it's not only affecting people leaving now, but of course also graduates choosing what they want to do with their future careers. So we've gathered a lot of anecdotes from bankers, from entry level to department heads, and, people are really down on the prospects of this industry, not just for the short term, but also longer term.
So where are they going? I mean, where are they finding jobs? I mean, obviously, global banks have been cutting a lot of China-focused jobs as well. Are there better prospects out there?
Yeah, I mean, that's the thing. Some people told us they're looking to places like Hong Kong. Some people are going into other industries like, digital industries. I know one person that's basically gone from being an investment banker to working in crypto. So it's, they're going where they can find jobs. But of course, in this job market and with the sputtering economy, there's not a lot of other great options. And of course, there are some people saying, lean camel's still bigger than a horse. Like, this is still an industry that objectively pays more, even with, half of your salary gone.
Yeah, I mean, it's all relative, isn't it? Interesting stat here from the story. You probably know this, but I'll read it to our viewers here. So Morgan McKinley, of course, which is effectively helps job consultancy firm here. 80% of firms in China's banking and financial services sector have lost talent in the past 6 months. Overall figure is 78%. That's quite a sort of across-the-board reduction in the labor footprint of this industry. Lucille, is there anything the government can and should do, maybe two separate questions, that might stem the exodus of talent from the sector, which is frankly quite needed, given where this economy wants to be in a few years' time?
Yeah, that's completely right. Definitely two separate questions. A lot that they can do, but we haven't seen any indication they want to. A lot of experts are saying, they kind of see the sector on the extreme end, something like pre-1978, where it's, just state-run banks, state-run insurers. They kind of see it heading in that direction. There's others saying, the financial sector has had a lot of blame for the buildup of debt in the industry, and the leadership might not want them anywhere near the levers of power again. So I think it's a matter of where people think this is going, and I think people are basically arguing that they don't want this many people in this sector. They want it to the sector to serve the people rather than fund these what they see as lavish lifestyles. So in the end, I think people aren't seeing any indication we want the sector to grow and prosper. Rather, we want the sector to be lending to the sectors that the government deems important, such as manufacturing, and we want the sector to, be very self-regulated, so that we don't have, the corruption probes that we have now.
All right, Lucille. Thank you, Lucille. They're great reporting from your team on really what you're feeling, what people are saying in the financial sector here, also in the mainland. You can also get more of the Insider's Guide, of course, into the money and people shaking up the finance hub in our new Hong Kong edition newsletter that's out every Thursday. You can sign up through Bloomberg.com/newsletters. Okay,
just to mark, so we had inflation numbers coming through out of Japan earlier on, lower but hotter than lower from the last month, hotter than expected, and that's driven up the Japanese yen. It's driven up yields, and right now the 2-year is back to the highest level since 2011. banking stocks are also rallying on the back of the prospect, I guess, of more bets that the BOJ can proceed at some point with normalizing policy. We're up 2% on that specific part of the equity market. Yields, as you can see, on the way up across the JGB curve. This is Bloomberg. The UK's Minister of State for Trade Policy, Greg Hands, says the economy will feel the impact of slower global growth and the turmoil in the Red Sea. Now, Hands spoke to Bloomberg at the WTO ministerial meeting that's taking place in Abu Dhabi.
I think it always concerns us when growth is undershooting what people are forecasting and what people want. Higher growth means greater prosperity, greater tax revenues for governments. You know, there's strong reasons why we want global growth to recover. That's why the UK, for example, is taking strong action in the Red Sea in concert with our allies to make sure that trade continues to flow and that the world does not suffer unduly from events in the Middle East.
You did mention that developing countries should benefit as much as richer nations and that this particular conference has been about that. What about the digital goods tariff moratorium? Does that get renewed for another 2 or more years?
Well, this is essential for the World Trade Organization. I mean, this would be really going backwards for it not to be renewed. This would mean that there would suddenly be the potential for customs duties on anything from sharing a Spotify through to Netflix, through to potentially anything that could be transmitted digitally could be subject to customs duties. Now, we think this would be a really retrograde step to go back 20 years or more when there are customs duties on electronic transmissions. We think that it benefits the whole world and developing countries in particular to not have duties on digital transactions.
Sure, nonetheless, some developing countries might see it as a chip to use in their favor if they could bargain with it, for example.
Well, our own estimates are that developing countries, whatever they might gain from the tax revenues from this, would be dwarfed by the losses to GDP. So 20 to 30 times as much loss in GDP compared to what they might gain out of tax revenue. So it's strongly against the interests of developing countries. It's against the interests of everybody. To put these customs duties on something which obviously people expect to flow pretty freely around the world.
Well, can your delegation help convince everybody else? What are the odds that this doesn't get done? I mean, you have to convince Indonesia, India and possibly other countries to go along with it.
I think we've got about 130 or 140 countries now have agreed that to not put customs duties on e-commerce transactions, or to, in this case, roll over the e-commerce moratorium. That's a pretty good position. I think the large number of developing countries and some very large developing countries agree with us that it would not be a good way forward.
Talk to us about the free trade agreement with India. Is it going to get signed before India goes to elections, likely late April?
Well, look, we've always said that what is important is the deal, not the date. What is important is what is going to be in the deal, and that negotiation is live at the moment.
What are the sticking points preventing it from getting done and dusted?
Well, look, there's a huge amount that you can do with India. There's so much can be done on a trade agreement with India. It wouldn't be right for me to say where are the areas that are being more difficult, but obviously we are looking forward to getting something done. We're putting a lot of time and effort into it across the whole of the UK system and on the Indian side as well.
UK Trade Minister Greg Hands there speaking with Vonnie Quinn. All right, another check of these markets here right now. We're checking very closely these EV stocks. There you go. I think that session highs for Li Auto. We're at 18% to the upside here right now on the back of those vehicle margin beat, despite what we've been seeing with this intense price competition that you're seeing across the sector here. So you are seeing that's lifting the whole EV sector here in China today. Crypto stocks, again, just talking about, you know, this Bitcoin price that continues to head to those more than 2-year highs. That certainly is one we're watching out for after we had led to what? We'll reach 54,000. We're watching 60 very closely now for the cryptocurrency, and you're seeing OSL groups of these crypto stocks up, flying this morning. We're watching Japanese assets too.
Yeah.
Logistics first.
Let's go. Yeah. That's, what was the logistics story again?
They were talking about building a unified
the local government one, the
market.
barrier to...
Yeah.
Okay.
Didn't really move much, but,
The national market out of the State Council. There we go.
But it's more about Japan now.
Yeah.
That inflation print really...
Oh, wow. That came out of, I would say came out of nowhere. So the core inflation print actually came in almost above almost every single forecast except for one.
Wow.
It's clear from market reaction that certain positioning was certainly not prepared for a reading like this. Now, it's also worth mentioning that we did get a pullback from the previous month as far as inflation goes. So the downtrend is still intact. I think we're down 5 or 6 months now on inflation. But when you look at these Japanese assets, 2-year yield at bottom of your screens, 13-year high. The Topix Banks Index is up 2%, for example. So that's really a story which we'll unpack in the next hour at Bloomberg Markets. Global macro movers for you. Have a look at where we are as far as that's concerned here. So equity markets are on offer. It's generally a cautious session across risk assets. The other story I want to talk about, which perhaps we're going to get into more tomorrow, second column, topmost is the Kiwi dollar. We're down 1/5%. Overnight's implied vol is exploding on the Kiwi dollar. We're now up to 17.5 points, highest here since early December. Keep in mind, RBNZ is tomorrow. Economists don't think they're going to move most, but there is a small minority.
ANZ thinks that they're going to hike, maybe. At least that's what some pricing still suggests they could sneak one more in. You take a look when it comes to those China dashboards, though, so we continue to see a pause across these markets. Of course, overall speaking, we're waiting still for that PCE inflation gauge out of the U.S. That certainly could be the next event risk out there. But HS Tech at least is keeping things slightly higher here. But you're still seeing a Hang Seng that is slightly to the downside, about 1/3 of 1%. Onshore is doing less bad. We're down about 1/10 of 1%. So certainly we'll continue to watch this space. Iron ore continues to be a down arrow story, though. We're down another 1% here today. And CGB's long end still catching a bid. That's it for us here at Bloomberg Markets Asia. We got Bloomberg Markets Asia coming up next. This is Bloomberg.